Executive Summaries, January 2026 edition.
Bangladesh garment industry in 2026. Challenges, prospects, and the imperative of global collaboration. As the global apparel industry enters a decisive phase of transformation, 2026 stands out as a critical year for Bangladesh's garment sector. Having firmly established itself as one of the world's leading apparel manufacturing hubs, Bangladesh now faces a complex intersection of challenges and opportunities. The industry's future competitiveness will depend not only on internal reforms but also on deeper, smarter global collaboration across production, marketing, and business facilitation. It is expected that Bangladesh would enter a new political phase following the national election that held on February 12. The ready-made garment industry, the economic lifeline of Bangladesh economy, stands at a moment of both reflection and recalibration against a backdrop of global economic uncertainty, geopolitical realignments, and rapid transformation of the apparel value chain. 2026 is emerging as a pivotal year. Indeed, 2026 will test Bangladesh RMG sector's resilience, policy coherence, and ability to collaborate globally. Bangladesh apparel industry contributes over 83% of country's export earnings, employs 4 million workers directly or indirectly through backward and forward linkage facilities, in addition to few thousands garment factories. Policy predictability, strategic reform, and deeper global collaboration are crucial for the development of the sector, which unfortunately we don't experience the way it should be. The global apparel value chain is undergoing rapid restructuring. Brands are rethinking sourcing strategies amid geopolitical uncertainty. The world that we have been used to live and do business is changing rapidly due to President Trump's America First approach that proposed new tariff policy changes and trade restrictions. It is not only creating challenges for doing business with US, but also due to US-EU potential standoff, Europe's economy might confront deeper challenges. Hence, garment business would be affected certainly. Also, global economies, inflationary pressure, sustainability mandates, and shifting consumer expectations have become new rule of the game. Speed, transparency, and resilience are now as important as cost competitiveness. For Bangladesh, this evolving landscape presents both pressure and promise. Pressure to adapt quickly and promise to move up the value chain if the right strategic choices are. We do believe that the defining factor for success in 2026 and beyond will be collaboration across borders and functions. Joint ventures, technology sharing agreements, and strategic sourcing partnerships can help Bangladeshi manufacturers upgrade capabilities while sharing risks and investments. Deeper integration with fabric suppliers, trim manufacturers, and logistic partners, both locally and internationally, will strengthen supply chain resilience. Global collaboration must also extend to trade facilitation, financing, and policy advocacy. Partnerships with international development agencies, financial institutions, and trade bodies can support access to green finance, export diversification, and smoother regulatory alignment with key markets. To secure the garment industry's future, the following policy actions should be considered effectively. Ensure energy reliability and competitive pricing for export-oriented industries. Work effectively on product and market diversifications. Accelerate customs modernization and port efficiency to reduce lead times. Develop a national man-made fiber MMF and textile diversification roadmap. Access to affordable green and transitional finance, especially for SMEs. Develop garment business development skills. Engage proactively with global buyers and trade partners on post-LDC market access. Ensure congenial work environment in the industry. A unified Made in Bangladesh narrative centered on responsibility, reliability, and readiness for the future must be promoted. The year 2026 should not be approached defensively. It must be approached deliberately with specific agenda to confront the challenges and clear goal to achieve the goal locally as well as globally.
reimagining the future of Bangladesh's RMG industry. Bangladesh's garment industry is the backbone of our economy. It helped transform a newly independent nation in the 1970s into a country that now exports nearly $50 billion worth of apparel. Today, garments make up more than 80% of our total exports, and the sector employs around 4 million people, most of them women. That success is powerful, but it comes with risk. Global demand changes, or when tariffs shift, or when logistics are disrupted, Bangladesh feels it immediately. We saw this with the US tariff threats and export disruptions. So the real question is not whether garments matter, they clearly do. The real question is, how do we make the industry stronger and less fragile? Bangladesh is the world's second largest apparel exporter. We hold around a 6 to 7% share of the global market. That gives us scale and recognition. So we don't abandon garments, but we must change what we produce and how we produce it. For years, we focused mostly on low margin basics that keeps profits small. Now we need higher value product, faster delivery, and more diversified buyers. We don't shrink the core, we upgrade it. One of Bangladesh's biggest strengths is scale. Thousands of factories are connected along with suppliers, freight handlers, labs, and skilled workers. Because of this network, costs are lower and production is faster. Now imagine using that same system to produce man-made fibers, technical textiles, and higher-end garments. Right now, we import most of the raw materials for these products. That slows us down and makes us vulnerable. If we produce more fabrics and trims locally, we can compete on speed and variety, not just price. The global industry is changing fast. Buyers now expect speed, quality, and sustainability. Factories that use AI planning, automation, and digital tools can reduce waste and improve efficiency. Yes, automation creates concern about jobs, but falling behind in technology could be worse. The goal is not to replace workers, it is to upgrade skills. When companies invest in training, workers can move into better paid roles. So the real strategy is simple: invest in technology and invest in people. Bangladesh already has the largest number of green garment factories in the world. That is not a weakness, it is a strength. As global brands demand cleaner supply chains, green at scale can become our advantage. If we combine sustainability with technology, we build long-term competitiveness. Around the world, governments are using industry policy again. They're supporting key industries, encouraging innovation, and building stronger supply chains. Bangladesh is at an important political moment that brings uncertainty, but it also brings opportunity. If reforms focus on transparency and smart investment, the garment sector can evolve. The RMG industry does not need to shrink, it needs to grow smarter, with higher value product, with local supply chains, with better skills, with better technology, with sustainability at scale. If we move in that direction, garments will not just be a pillar of today's economy, they will become the foundation for Bangladesh's future. Prospects for the garment sector. Bangladesh's garment industry had a strong run in recent years, but as we move into 2026, the outlook is far less certain. Trade rules are shifting, energy shortages continue, and buyers are hesitating. So the big question is, what can we realistically expect from the RMG sector in 2026? Let's start with the data. In 2023, total exports stood at just over $40 billion. In 2024, that rose to more than $47 billion. But in 2025, growth almost stopped. Total exports increased by only about 1%, and RMG exports also grew by roughly 1%. That slowdown is important because it tells us momentum is already weakening. The main problem is uncertainty. The final trade agreement with the United States is still not signed. A new government is coming, and buyers are waiting. Retailers do not like uncertainty, so instead of expanding orders, many may hold back. And if negotiations restart under a new team, that delay could stretch even longer. There are also concerns globally. Growth forecasts for the US economy have been lowered. The same is true for the European Union. If consumers in those markets spend less, apparel demand could weaken. A strong surge in international demand for Bangladesh garments, that looks unlikely in the short term. Demand is only half the story. On the supply side, the challenges are very real. Bangladesh continues to face gas shortages, electricity shortages, and transport bottlenecks. The Chittagong-Dhaka highway is increasingly congested. Customs delay remain long. Air cargo is still chaotic. Even if factories have capacity on paper, actual exports are constrained by these supporting systems. And unless energy supply improves, production cannot expand meaningfully. Interestingly, industry capacity is increasing. Local owners are investing. Chinese investors are showing stronger interest, so factories may be ready to produce more. But without stable electricity and gas, that capacity cannot be fully used. So where does all of this leave us for 2026? Not in a position of strong optimism. The projection for RMG exports in calendar year 2026 ranges from +2% to -7%. After weighting expert opinions, the most likely outcome is around -4%. That is not a collapse, but it is clearly not growth. Over the next few years, demand will likely recover. Global incomes will rise. Environmental and labor standards will improve. But in the near term, the real priority is simple. Fix the electricity system, increase gas supply. Because without energy, the garment sector cannot move forward. US tariff shock puts India's textile and garment exports under severe strain. India's textile and garment industry is going through a very difficult time, and this pressure is coming mainly from one place, the United States. New tariff threats are adding to an already heavy burden, and for many exporters, the situation is becoming hard to manage. The biggest concern is a new proposal supported by US President Donald Trump. The Senate bill could allow tariffs of up to 500% on countries that continue buying Russian oil. If that happens, it could be added on top of the existing 50% duty already placed on Indian goods. For many in the industry, that could make exports to the US almost impossible, and that is serious, because the US buys around 30% of Indians' garment exports. Key production hubs like Tirupur, Karur, and the NCR Panipat belt are already feeling the strain. Small and medium factories are the most vulnerable. Many of them are working on thin margins. To survive the current 50% tariff, exporters have been lowering prices and sharing costs with buyers. In many cases, they're absorbing part of the duty themselves. Profits have fallen sharply, and this cannot continue for long. Some factories are already facing working capital pressure. If tariffs rise further, closures and job losses could follow. Buyer behavior is also changing. Recent data shows India's textile exports to the US have fallen. At the same time, Bangladesh and Vietnam have seen growth. American buyers are shifting orders to countries with less policy risk, and they're reluctant to absorb the full tariff costs. This uncertainty is slowing down new bookings and future orders. Large exporters are trying to reduce risk by setting up factories in other countries, but smaller farms cannot easily do that. Rebuilding supply chain takes time and money. The issue is also tied to geopolitics. Many of the US tariffs are linked to India's purchase of discounted Russian oil. India relies on that oil to keep energy prices stable. Completely stopping those imports could raise costs at home. At the same time, legal uncertainty in Washington adds more confusion. Even now, Indian goods already face high cumulative duties. Exporters are making decisions without clear policy direction. On the larger scale, India's economy remains strong. The United Nations expects growth of over 7% this fiscal year. Domestic demand and public investment are supporting the economy, but long-term tariffs could slowly hurt exports, and markets like Europe or the Middle East cannot fully replace US demand. Industry leaders say government support is essential. Easier credit, stable policies, and access to affordable raw materials will help. Without clarity on US trade policy, India risks losing market share. And once buyers shift sourcing, it is hard to win them back. For millions of workers and thousands of factories, this is no longer just a trade debate. It is a daily business challenge. And the coming months will decide how strongly India's textile sector can hold its ground. Pakistan strives to revive exports amid structural challenges. For the last 20 years, Pakistan's exports have stayed almost stuck between $25 to $35 billion. Meanwhile, rivals like Bangladesh and Vietnam have surged ahead. So the big question is, why hasn't Pakistan been able to break out of this export trap? Recent numbers show the pressure is increasing. In December 2025 alone, imports rose to around $6 billion, while exports dropped sharply to $2.32 billion, a fall of over 20% compared to the previous year. Even textiles, the backbone of Pakistan's economy, fell by around 9%. Food and agricultural exports dropped even harder, by about 35% in the first half of the fiscal year 2025-2026. This is widening the trade deficit, and exporters are clearly struggling. There are a few major barriers that keep coming up again and again. First, energy costs. Electricity and gas tariffs are high, unpredictable, and above regional competitors. This pushes up production costs and kills competitiveness. Second, policy uncertainty and taxes. Exporters face advanced taxes, delayed refunds, and sudden policy changes. This ties up cash and increases borrowing. Third, Pakistan still relies heavily on low value-added exports. Textiles, yarn, and basic garments dominate. Meanwhile, higher value sectors like IT, seafood, minerals, and modern apparel are still underdeveloped. And finally, there are major gaps in logistics, skills, and infrastructure. High freight costs, weak testing facilities, and poor cold chain systems limit growth. But the government knows the situation is serious. So now the big focus is on pushing Pakistan towards export-led growth. Pakistan has recently formed task forces and high-level committees to address the crisis. One committee led by Planning Minister Ahsan Iqbal has highlighted the need for structural reforms, especially on tariffs, energy pricing, and the overall cost of doing business. Another Export Emergency Committee, chaired by Deputy Prime Minister Ishaq Dar, is working on a plan to push exports to $60 billion billion within 4 years. The government is also promising support for exporters and SMEs, faster tax refunds, better financing options, and smoother processes in the economic zones. The goal is to ease cash flow problems and restore confidence. The reality is simple. Pakistan cannot reach $60 billion in exports with short-term fixes. To truly grow, the country needs long-term consistency, lower energy costs, better infrastructure, stronger skills, and more value-added industries beyond basic textiles. Right now, Pakistan's export remains stuck near $25 to $35 billion. But if policies stay stable and reforms are real, an export-led model could finally become possible. Because in the end, exports are not just numbers, they are the backbone of economic survival.
Tribunal closure for closet economy. In 2026, the biggest fashion flex isn't a massive closet anymore. It's how quickly you can change your wardrobe. Because, let's be honest, most of us don't even wear half the clothes we already own, and yet we still feel like we need something new. That's exactly why fashion is entering a new era, the rental revolution. This shift is being driven mostly by Gen Z and Gen Alpha, and the numbers are huge. By 2035, they're expected to make up nearly 40% of global fashion spending. That's not a small change, that's a complete takeover. But their mindset is different. They don't care as much about owning things, they care about access. And honestly, it makes sense. This generation is super eco-conscious, but at the same time, social media puts insane pressure on them to look fresh in every photo, every video, every post. So renting becomes the perfect middle ground. You get the new look without the guilt of buying something you will only wear once. In fact, nearly 55% of Gen Z consumers are already renting clothes, or at least considering it. But here's the real twist. This isn't just a trend. It's changing how the entire fashion industry looks. This is where the idea of fashion as a service comes in. Instead of buying clothes, people subscribe to them, just like Netflix. They pick outfits through apps, get them delivered, wear them, return them, and the company cleans and repairs everything before sending it out again. In places like European Union, digital product passports are also being introduced. Basically, a digital ID that tracks how many times a garment has been used, repaired, and reused. And big platforms like Rent the Runway are already leading the way, while newer apps are mixing rentals with resale and social sharing. Now, of course, rental fashion sounds sustainable, and in many ways it is. It reduces waste by keeping clothes in circulation longer, but it's not perfect because delivery and cleaning also create emissions. So unless a garment is rented many times, the environmental benefit can shrink. That's why future of rental fashion depends on smarter systems like local warehouses, repair hubs, and low carbon delivery. And the biggest sign that this is here to stay, major brands like H&M and Zara are already moving into rentals, resale, and repair. So in 2026, fashion isn't about owning more, it's about rotating smarter. Because the trendiest people won't be the ones with the biggest closets. They will be the ones whose wardrobes change as fast as their lives do.
Post-income analysis, how Christmas spending will impact the first month of 2026. Every January feels a little tighter. The holidays are over, the decorations are gone, but the spending, that lingers. And in January 2026, that financial aftershock may feel even stronger. December is emotionally charged. Families spend on gifts, food, travel, and entertainment. Spending rises sharply and often goes beyond regular monthly budgets. Some households plan ahead, but many rely on short-term credit cards, buy now pay later services, and overdraft. So when January arrives, income stays the same, but repayments increase. That's where the squeeze begins. This year, the pressure is heavier. Inflation is still affecting daily expenses. Interest rates remain high. For households with variable rate mortgages or credit balances, debt servicing becomes more expensive. Rent, utilities, transport, insurance, those costs do not change. But Christmas debt adds an extra layer. So households reduce discretionary spending. Fashion, dining, leisure, these are usually the first to slow down. From a broader economic perspective, January often brings a temporary slowdown. Retail turnover softens, consumer confidence dips. This is not necessarily a crisis, it is a seasonal correction after holiday access. But in fragile economic environment, that correction can feel sharper. Retail employment hours may fall, small businesses may see tighter cash flow, and part-time workers in retail and hospitality often experience reduced hours after the Christmas peak. For many households, that compounds the pressure. Interestingly, January also triggers a financial reset. Many households try to rebuild savings. They cut back, they budget more carefully. This strengthens balance sheets in the long run, but in the short term, it reduces spending across the economy. Not every sector suffers. Discount retailers and essential goods often perform relatively well, but overall, the mood remains cautious. So what does this mean for January 2026? It means adjustment. Christmas acts as a short-term economic stimulant. January becomes a consolidation phase. Household cash flow tightens. Discretionary spending falls. Financial awareness rises. Income may remain stable, but real purchasing power feels smaller. For businesses, this cycle shapes post-holiday strategy. For policymakers, it reflects the importance of credit conditions and consumer confidence. And for household, it is a reminder. January is not just a quiet month. It is where seasonal spending, depth, dynamics, and economic reality meet. Overview of Puma and its thriving strategies. Puma is one of the world's most recognizable sportswear brands, but what makes Puma stand out is how it blends performance, culture, and fashion into one identity. It's not just a sports brand, and it's not just streetwear either. It sits right in the middle, and that balance is exactly why Puma continues to thrive in a market dominated by giants. Puma is not just following the industry, it is shaping it. Puma was established in 1948 by Rudolf Dassler in Germany. From the beginning, it built its name through sports, athletes, and major global tournaments. Its early innovation in football boots and track spikes helped Puma gain credibility worldwide, and that sporting DNA still shapes the brand today. One of Puma's biggest strengths is its positioning at the nexus of sport and culture. It does not compete only on performance or price. Instead, Puma focuses on attitude, uniqueness, and self-expression that attracts consumers who want both function and style. Innovation is a major part of Puma's strategy. The company invests heavily in research and development. It has improved cushioning, lightweight materials, and sustainable fabrics, especially in running, football, and training categories. But Puma also makes sure performance technology becomes visually attractive, so the product works in sport and still looks good in daily life. Another key factor behind Puma's success is partnerships. Puma collaborates with designers, artists, athletes, and cultural leaders, and these are not short-term gimmicks. They influence product lines, marketing campaigns, and the brand's identity, helping Puma stay relevant among younger consumers. Football remains one of Puma's strongest categories through sponsorship of clubs, national teams, and elite players. But Puma has also expanded into basketball, motorsport, running, and women's fitness, giving the brand a diversified sports portfolio. Sustainability has also become a strategic priority. Puma has invested in recycled materials and stronger supply chain transparency. At the same time, Puma is pushing its brand elevation strategy with major campaigns like Forever Faster. The company is also expanding direct-to-consumer sales, strengthening e-commerce, apps, and retail experiences. Ultimately, Puma's success comes from its ability to evolve without losing its identity. It combines performance credibility with cultural awareness, and as sports and fashion continue to blend, Puma is not just following the industry, it is shaping it.